Okay, well, good morning, everyone, and thanks for joining us for the fourth installment of LaPorte Cafe. As always, our goal today is to provide you with a trending topic that we see affecting the public sector in order to provoke some conversations, both internal and external, that'll lead to some improvements and strengthening of your organization. And today, I think we have a pretty good one. We're talking about leases. So just a bit of housekeeping before we get started. All attendees are muted and the video is off and the chat function is disabled. Our presentation is strictly conversational with no prepared slides, and you can ask questions in the Q&A portal. If it's located below, you'll see the button there. My name is Richoux. I'm a director in audit and assurance services, and with me today is Mickey Simon. He's also a director in audit and assurance services. And just, you know, the accounting world's been talking about leases for probably the better part of a decade now. You had the GASB and the FASB going at it, and here we are. We're implementing this this calendar year for most folks. So let's get into the basics. So Mickey, help us understand what's the definition of a lease. What are we talking about today?
Okay. Well, of course, you know, the formal definition is a bit formal in the guidance, but in simple terms, and today we're going to try to keep it conversational, as Lester mentioned, but it's a contract where you get the right to use and here read control some underlying asset that belongs to someone else. So that asset has to be non-financial, but essentially control here means that you have the right to say how and when that asset is used, and you have the right to all of the service capacity of that asset.
So I think an important distinction you just made is you didn't talk about what we're used to understanding with leases. No, you didn't mention the word capital or operating. So right. As folks might remember, you had your old capital lease criteria, and you decided whether you recorded that on the statement of net position, and then you had your operating leases. You maybe evaluated that criteria and didn't record it. So that's all changed now. We didn't use those terms. We're only strictly looking at whether we have the right to use and control that asset, and that's how we'll evaluate going forward whether we apply this guidance to that contract in effect. So Mickey, are all leases included in this guidance, or what's carved out of this?
Okay, so no, it's not going to be for short-term leases and any contracts that transfer ownership to the lessee. So, you know, in those cases, you would not be following GASB 87.
So an important concept here is to understand the term of the lease, right? The length of the lease that's subject to GASB 87. And there's a good bit of criteria and things we need to talk about or go over. Help us understand the term and how we go about evaluating that.
Okay, so right, the term will be, and I don't want to read the standard to you guys too much, but I'm going to quote it here just to make sure we're good. The term will be the period during which a lessee, has a non-cancelable right to use the underlying asset plus, end quote, and then there's the 4 criteria that could extend it or shorten it, such as are there options to extend it, and then what is the level of certainty that those options will be extended or terminated early. So you want to take those into consideration.
Right. So it sounds like an important element when you sign this lease and you enter into this agreement is just to evaluate those terms and decide, you know, you sort of have to have a little bit of a crystal ball, right? You have to decide whether you're going to extend it or cancel it in other aspects in order to determine how you're going to proceed forward from that. So an important, well, that's where the judgment, your judgment of your organization and what you think is going to happen, and maybe a little forward looking into the future and the economics of your environment come into play to decide the terms of these leases. So I know we said we're carving out short-term leases. So how are we defining that and treating those?
Okay, so a short-term lease is one that, you know, when the lease starts, you're looking at what is the maximum possible term. Okay, so if it's 12 months or less, that would be short-term, but you have to think of what is the maximum possible length that this lease could go and include any options to extend regardless of the probability that they'll be exercised. So where you might have determined that, you know, that lease is 12 months or less, once you take into consideration all those options, okay, it's the maximum time, then you would just go about recording them the same way you would in the funds. And so, in fact, there's a great question, Lester, and just an implementation tip for our clients. If you're getting to that point, where you're looking at that implementation date and saying, well, I've got a lease that was in process and there's only X number of months left. Do I include that as short term or not? There's an implementation guide 2021-1, and it's question 4.22. And they discuss a lease that's in process at the date of implementation and whether it would be considered short term or not. So rather than get into the weeds with it, I would just point clients there. And of course, you can always call us with questions once you've looked at that.
And just so we're clear, month-to-month leases, we're defining those as short-term?
Correct. Month-to-month is considered short-term, and there's no need to change anything with that.
Okay, so now that we've identified a lease and we know the terms more than 12 months, we'll proceed forward in the fund financial statements as we always have. We'll record the lease. Maybe before we recorded a capital lease, but all leases, we've gotten rid of those terms. We're recording the lease in the fund financial statements as a other financing source, and then a capital outlay. And then, of course, when you make your regularly scheduled payments, we'll proceed as always with expensing that and any accruals that are necessary. So the fund financial statements unchanged, but really where the heart of the matter is in those government-wide financial statements and how they're going to look going forward. So Mickey, let's jump into it. This is the part that's important in the change that's going to be significant to everyone.
Sure, and that's definitely an important distinction to make. That we're looking at government-wide here for when we talk about these lease liabilities that we're going to talk about, and recognize also that here in 20 minutes we're going to be covering the basics. The guidance is quite nuanced. There are a lot of little things that we're not really bringing out here, but we're just sort of covering it sort of at a higher level. But so once you've identified a lease, what you do with it, again from a high level, is going to record a lease liability, which is going to be a long-term liability. And just like your other long-term liabilities, you'll carve out a current portion and a non-current portion. And then on the other side of that, you're going to record an intangible right to use lease asset, okay, which you can classify in the statements with capital assets. We'll talk at the end about disclosures and breaking those out from capital assets. But so the fact that you have a liability and an asset, let's just focus on the liability first, how to measure that, and then we'll jump to the asset in just a second. So the lease liability, you're going to measure that at the present value of all the future payments under the lease. So obviously you're going to start with those fixed payments that are under the lease, the fixed payments that you have to make. And probably most leases will include primarily fixed payments. Some leases do have variable payments. And then you would also include any other amounts that are reasonably certain of being required. And there's a list of other things that you could consider. Again, probably not as common as the fixed payments and the variable. So variable payments would really be something like if it was a defined CPI related escalation, that it's going to jump up, or I guess it's a defined escalation. So you'd have to determine, how to include that or whether to include it. So then there is one type of variable payment that you would not include, and that is if the variable payment is based on some future performance. So for example, if it's based on the number of hours something is used or the number of copies, say for a copy machine, that's variable. And I guess they feel like it's maybe too hard to predict. And so you wouldn't include it in that present value. Of course, when you present value something, you're going to make assumptions. One is the discount rate. So the discount rate you would use is primarily the rate that's either explicit in the contract. If it's not explicit, then you would look for the implicit rate and how you can, find that. Or if it cannot be determined, then you're going to look at the lessee's estimated incremental borrowing rate, which is essentially the estimate, it's some estimate of the interest rate that you would be charged for borrowing that amount over that period of time. And so you would kind of look at your current environment and what you could borrow money at. So then as you pay the lease, again, we're staying on the liability side. As you pay that lease, you're going to reduce that liability using the interest method. So you're going to have, when you make the payment, you'll have an interest expense portion. And then after that, you'll reduce the lease liability. Okay, now the lease is going to be pretty much set it and forget it unless some event occurs that makes you want to remeasure the lease liability, and the guidance talks about why would you want to remeasure. Again, not to get into that whole list, I was trying to stay within 20 minutes, but the main thing to remember is that in general, if one of the assumptions you made at the beginning, especially the lease term, changes, that's a trigger, and then you have to remeasure that lease liability. And then the thing to remember there is if you're going to remeasure the lease liability, you'll also want to revisit that discount rate. And then, along with that, another implementation tip here, the guidance is applied retroactively. So if you have comparative financial statements, you want to make sure that you're, measuring the impact of that back a year. So that could be quite complicated. So, we're willing to talk offline with anybody that has that situation. So, all right, so let's move on to the right of use lease asset. When you're making that initial entry to record the the lease liability, then the offsetting asset, is going to be recorded at essentially that same amount. And the guidance said you would add any additional payments that you make at the start of the lease, and any cost to place that asset into service. Again, if they're material, you always want to, caveat some of this with materiality, of course, but less any lease incentives that are given at the start of the lease. Okay. And then moving forward, what do you do after it's set up? The lease asset is going to be amortized in a systematic and rational manner over the shorter of the lease term or the useful life of the asset. And then you're going to record that as an amortization expense. For reporting purposes, you can lump it with depreciation expense, but in your disclosures, you'll carve it out. You'll disclose it separately. Further, I do want to talk about one time where the term that you amortize over is defined, and that is if the lease contains a purchase option. Then the lessee is going to determine if that's reasonably certain of being exercised, and if it is, then that lease asset should be amortized over the useful life. So it's not a choice. If you pretty much figure that you may exercise that option, then you're going to use the life of the asset rather than the lease term if it's shorter. So, and then of course, while we're talking about it, if you're leasing land, that's normally not a depreciable asset, so you wouldn't amortize it here either.
So I think, one of the things you mentioned, and we all have to wrap our heads around, is just that new term, the right of use asset. So just going to be something new. It's a new term, but it should be fairly straightforward. It's the actual asset that you're leasing, right? So let's circle back for a minute on something you mentioned as far as the guidance referring to funding or non-appropriations clauses. Sometimes they call them cancellation clauses, where the government entity can actually cancel the lease and doesn't appropriate the funds to make those payments. Explain to us how that affects the lease term.
Well, pretty simply, it should be considered in the lease term only if it is reasonably certain that that clause will be exercised. That's what the guidance says. It's pretty straightforward on that.
Right. And since we threw it out, we talked about non-appropriations clauses. I think we're all familiar with why that comes into play. Obviously, here in Louisiana, you have to go before the State Bond Commission approval for certain issuances of debt. And we've had the question come up from some clients, previously operating leases, we never recorded a liability on the books. Do we have to go to the State Bond Commission for approval for that? All leases are essentially putting the liability on your statement of net position now. So how do we approach that? How do we approach going before the State Bond Commission now that the GASB has implemented this new standard? And I know you've had some recent conversations, so help us out and understand what we found out.
Yes, so that question did come up from a client of LaPorte, and after some of us getting out to the legislative auditor, and they came back with, and I guess just from a high level, just remember that the accounting guidance and the legal guidance is separate, but they referred to the revised statute 39:1410.60. I can give y'all that. Reach out to me afterwards if you want that again. But that basically says that leases that meet certain criteria are not considered debt by the State Bond Commission. And so to kind of paraphrase that, if it has 3 elements, then you would not need to go to the State Bond Commission. Those 3 elements are containing the non-appropriations clause, like we just talked about. It does not have a penalty clause, meaning you would have to pay a penalty if you got out of it. And then 3, it does not have an anti-substitution clause, which would allow you to substitute for that asset. So if it has those 3 elements, you would not need to go before the State Bond Commission. And, even within LaPorte, after, kind of getting that answer and processing it a little bit, we've actually gone back out to the State Bond Commission, because that revised statute, if you read it, it talks about movables. So these rules refer to movables. So the question really came up on land and buildings. And so, the question's been sent back to them. We're in process with that. So if that becomes of interest to any of our clients on the call today, you can definitely reach out to us. I would imagine, that answer might be, forthcoming in the next week or 2. So just wanted to point that out, since it's something that has come up, and it's going to trigger that when you say, okay, well, now I've got a liability that I've never had before. How does this relate to the State Bond Commission?
Yeah, great. But just a key takeaway for everyone, and just keep that in mind, and how, a new standard implementation affects compliance here in Louisiana. So I think some key points we want to just kind of circle back on is just how to prepare, or what you've done to prepare at your organization to implement these new standards. Obviously, most folks are probably in it right now. So I guess we probably should have mentioned the effect that this was effective after the delay from GASB 95 for periods ending after December 15th, 2020. So basically, if your fiscal year started this year, you're implementing now. So I see some folks on our July 1, 2021, 21 fiscal year starting. So you will have hopefully put some thought into this and implemented or started implementation. But Mickey, help us get a feel for maybe some key points as far as maybe softwares, or maybe using Excel or something like that to prepare these entries and journal entries, and maybe recording this. What have we found out?
Sure. So I think also you want to start with, you've got to first look at capturing how, which agreements you have in place to begin with. So obviously you'll know about a handful of them, or a certain amount of those, but you want to be checking the rent or lease expense GL accounts. Any vendor summary reports are good places to start, to sort of trigger that thought process of what other contracts might we have out there. Because it's important to remember too, a contract may not say lease on it, but it may have a component that's a lease within it. And so you have to consider those as well. Also, you want to consider materiality. You want to consider, I think, a really good lease software. Not only, like Lester was saying, not only does the software do the calculations and give you the numbers, but it's also going to give you the journal entries. It can give you the amortization tables and things like that you can follow. And it's going to make those times, especially, we talked about remeasurement earlier. If you do have to remeasure one, the software will make it much easier to stomach those times, because I would imagine that could get a little hairy as well. So if you're looking at software, if you haven't done any research on these, I know that you can go to certain vendors and you can have them do a demo for you, and you can see which one you like. I know we've done demos here at LaPorte, but if you want to have a conversation about that, you can definitely contact me, and we'll have some resources that maybe we can turn you on to at this. And I think a consideration is how many leases you'll anticipate having. Another good resource that I did find recently is on the GFOA website. It's gfoa.org/materials/accounting for leases. And I know I said that really fast. I'll try to paste it in the Q&A. And then let me just close with this. I will try to paste that in the Q&A when we're closing out here. But the last thing that I kind of wanted to cover was just the disclosures. We talked about the accounting, again, high level, not all the intricacies of it, but just looking at the disclosures, and this isn't even the whole list, but again, just to cover the basics here, you're going to have a separate footnote. More than likely, you're going to give a general description of those leasing activities, the types of things that you're leasing. You're going to list your total lease assets with your accumulated amortization. So again, I mentioned earlier, even though you might have them together with capital assets on the statements, in the footnotes, you're going to break them out and you disclose them separate from capital assets. You're also going to have your lease lease assets by major class of assets. So if you got equipment and land and buildings, you're going to separate those out. Any outflows for variable payments, you're going to disclose separately, and payments on short-term leases that are not captured in that lease liability, you're going to disclose those as well. The principal and interest remaining on the lease liability in your 5-year sort of pattern that you do with bonds and other debt, you're going to do it the same way here. And then any sublease arrangements, sale, leaseback, probably not that common, leaseback, things like that would be in there. So I just wanted to mention those disclosures so you can start to think about, with those footnotes, what are the things that we're going to have to break out? It's going to mean more than likely, like I said, another footnote, and what is the information you're going to have to gather for that. So I just wanted to bring that out. So Lester, I see we're at 20 minutes. So what do we need to do to close out here? Do we have any questions? Or
We didn't get any questions, but hopefully everyone's thinking about this, and we're always offline. If you have any questions, please email us, contact us. We want to help you with this. This is a daunting task to undertake, and certainly we've gone through the guidance. So if you have any additional questions after we go offline, please reach out to us. Mickey, I believe you've selected our winner for today for our cup of coffee.
yeah, well, I picked random number 4. So who's 4 on the list here? Let me see. 1, 2, 3, 4. Cheryl Hoover.
All right. Well, we'll reach out to you, Cheryl, afterwards. And we really thank everyone for joining us today. And good luck with the implementation. Have a great morning.
All right, guys. Thanks so much. Bye-bye.